Hi there. Let's take a look at a past exam question, a 9-mark question from 2019 about debt and shareholder dividends. There's the question on the screen. As with all of these videos, if you get a chance, maybe pause the video, have a think about what the question is asking, and then we can start to plan a response. The key, as always, is to unpick the demands of the question. What's the start and end point? What's the question about? Where do our arguments need to get to? And in particular, what is the wording of the question? What is the examiner asking us to focus on? The fourth part of unpicking the demands of the question is the scope. How many arguments do we need to make this answer towards the top level of the mark scheme? Well, I think this question is about debt, increased debt as a source of finance for this project, but we need to get to, our arguments need to get to the end point, which is the effect on dividends. And therefore that key part of the wording is the effect. How does increased debt affect the ability of the business to pay out dividends to shareholders? How many arguments do we need? Well, just looking at the question, analyse how this change might affect the level of dividends. It doesn't say analyse the ways it might affect. It's this change. So singular, therefore one argument will be enough, provided it's well developed and focused on the question, to get to level 3. Just a few seconds on debt. A quick reminder, debt is one source of finance. These are long-term loans. So there's two parts of those. You end up repaying the loans down the line, perhaps after 2, 3, 4, 5 years. But right from day one, you start to pay interest on the loans. And of course, the effect of the interest is that will reduce profits achieved for the year, which might affect your ability to pay dividends. A company always has the option to pay dividends or not, but clearly it's going to be influenced by how much profit it's earned. However, if this new project is profitable, has high returns, hopefully higher than the interest rate or the interest cost, that might actually allow the business to pay higher dividends rather than lower dividends. So lots of a variety of points we can make. As with all of these things, there's no right answer to this. It's just a question of picking a relevant point and developing it. 9 marks, you haven't got a lot of time to do too much thinking. You need to crack on and develop 1 or 2 points. In this case, 1 point. Let's just have a look at some possible points. The top one there, higher gearing will reduce profits available to pay out as dividends because of higher interest costs. A classic line, absolutely right. Higher debt, higher interest, therefore lower profits. That will affect dividends. The second argument, a bit of a counter argument. Although the business will have higher interest costs, the project returns may actually increase profits available to pay as dividends once the project starts to earn its return. And a third, perhaps more subtle point, is that the increased funding that comes into the business from the loans, the bank loan comes into the bank account, could actually be used to pay dividends from profits earned in earlier years, so-called retained profits. So if you don't spend all the cash straight away on the project, you might actually be able to increase the amount of dividends because you've got more cash to spend. Okay, so let's just pick one of these. I'm going to pick the middle one here just as an example. Any one of these points will be okay to develop. And here is my effort at coming up with a contextualized argument, one argument that hopefully addresses the demands of the question. Let's read it through, see what you think. As with all of these things, have a go yourself to come up with your own point. Although financing the new project using long-term debt will mean higher interest costs on the new loans, thereby reducing the profit available for distribution to shareholders as dividends, this does not necessarily mean that shareholders will receive a lower level of dividends. This is because, so developing our argument here, the new project will hopefully, in time, earn a higher return than the interest costs of the debt used to fund it, thereby increasing profits overall and enabling the business to pay out higher dividends. Also, if the debt is not all used at once on the new project, perhaps some of the cash outflows arise later, the business may in the short term have increased cash balances available to pay out dividends and profits from previous years, if it wishes to do so. So actually I've sort of combined point 2 and 3 into one hybrid point there, basically arguing that actually the increased proportion of funding will not necessarily negatively affect the level of dividends received by shareholders. I think that point's absolutely fine. Certainly, I think gets you to level 3, addresses the demands of the question. You don't have a lot of time for 9 marks, 10 minutes max. Move on to the next question. Hopefully you found that useful. I'll put a link on here to some other example answers on YouTube and on the TutorD website, and some other useful links as well.